In this episode, we get the most startling statistic about energy prices and GDP growth, a hated sector that you should absolutely be investing in right now, and tons of macroeconomic insights that rebut all that recession talk. All that and more in this episode with Talley Leger, Chief Market Strategist at Wealth Consulting Group. Listen in right now. Welcome to The Big Skinny with Lou Basenese, where we serve up everything. One headline that you should probably ignore because the consensus is often wrong. One chart you definitely should pay attention to because the data seldom lies. And one investment insight that you could use right away to hopefully increase your bottom line. I am thankful today to be reunited with Talley Leger, Chief Market Strategist at Wealth Consulting Group. Good to see you again.
Good to see you too, Lou.
I think, man, we lost touch after being on Yahoo Finance once and said we'd get together, and here we are probably 6 months later.
So. Well, that was a great segment. So let's repeat the success.
Let's try, man. I enjoyed the conversation, the back and forth. So look, you sent some notes ahead, and I love it, right? Because I think what's prevailing in the headlines now is this talk about energy prices rising, a recession is all but guaranteed. You don't think that's necessarily the case. How come?
So I think it has a lot to do, Lou, with the changing structural dynamic of the U.S. economy. Very different today than where we were back in, say, the late 70s or early 80s, where the energy intensity of our economy is much, much less. So when you flip that concept on its head today, if you think about the productivity, we're producing about $75 of GDP per $1 of energy consumed versus $25.
What was it before? So 25. So you're talking in 4 or 5 decades, we've tripled the productivity out of a unit input of energy.
Precisely.
So what is the implications of that, right? Because I think conventional wisdom has always been that if oil spikes, 40, 50%, it's pretty much guaranteed that we're going to have a recession. Yeah. Where do you look for the cracks to see if that's going to happen? Is it the duration of the oil spike? Is it certain areas of consumer spending pockets that you look for, jobs? Where's the warning signs for you in case it is different this time?
Yeah, well, so we're always asking those same questions as kind of paranoid, responsible stewards of capital. But again, you can look at just consumption on energy goods and services as a share of total consumption. And that, as we know, is the main cylinder of the U.S. economic engine. But I'm happy to say that we've got a four-banger, and most of the Pistons are firing.
So when you say four-banger, what do you mean? What areas are you talking about?
So consumption.
Because I think of like when we were growing up, like headbangers and heavy metal. When you say four-banger, I want to know what that is clearly.
Well, that's the four-cylinder engine that we have that is basically humming. So consumption's hanging in there. Business spending is probably the real bright spot right now on the economy. Even government and exports, which I think was underappreciated. All four there kind of falling into line. But the quote unquote energy tax, it's present, but it's, I would say, smaller than it was back in prior decades.
So you said in your note, and I loved it, is don't wait for the straight. So don't worry about this energy tax because it has less of an impact. I mean, so you're saying people should be continuing to invest through this regardless of how long it lasts.
Well, it's that famous Rothschild quote, buy on the sound of cannons. I know I sounded like an idiot when I put that note out, but it worked just fine, didn't it?
It did. I mean, look, we got back in, I think, 11 days back to the previous highs and then, back chugging along on the backs of earnings, which I know we'll touch on later. But you sent in an interesting chart too with the conventional thinking is that oil prices are up, oil energy stocks are up, consumer discretionary is down. But you're saying there's a signal here to actually be buying consumer discretionary, which is one of the worst performing sectors right now in the S&P 500.
So when you go back to March, not that long ago, we've had a noticeable easing in the price of oil in Texas. We're 95. You're an energy guy. So
I know
these things better than I do. Meanwhile, consumer discretionary has rallied off those lows and energy has pulled back. And so I think that this relative outperformance is in its early innings, Lou.
No, I love to hear that. I mean, I'm of the same conviction. Where do you see any mixed signals? Because I look in the last week or so, we've digested a lot of fast food, quick service restaurants, which have been sending like Shake Shack down, right? But then you had very favorable results coming out of McDonald's. I know you don't necessarily pick individual stocks, but how do you read through those results in terms of getting a pulse of the consumer and where they're spending or where they're not?
Yeah, well, so one very interesting mixed signal or dichotomy, which is quite unusual right now that I've been talking and writing about, is the simultaneous outperformance of the mega caps and the small caps.
Yes.
It's been a bipolar market. So investors have been flocking to the bouncy castle for safety. That's the mega cap fortress, bulletproof earnings, 27% led by the Mag 6 so far. We'll wait for NVIDIA on the 20th.
I don't think that's going to be a surprise at all. I mean, it's going to be good as how good is it going to be?
Correct. But they're also, kind of flashing the card for growth with smaller small caps. And so that's the play right now. I think the peace dividend would do a lot to kind of get us out of this manic market and kind of resume the broader trend that we've been
So the peace,
seeing.
some sign of reopening of the strait is the medication for this bipolar market. My question is, you touched on small caps. I think they're up 45% in the last year, somewhere around that. Were you early and wrong like I was predicting a small cap resurgence, or when did you kind of see that materializing, and how early do you see that? Because I mean, for a long time, 11, 12 years, small caps have been underperforming. They finally seem to be outperforming.
That's a good point. And so I bought IWM in the second week of April 2025. And it's one of, if not my best performing positions, along with MSCI ACWI X USA. The Q's have been doing just fine too.
The global developed markets without
international.
The US.
Exactly. But back to your question about small caps, I just reinforced that with a special report. I think it was in October about a major turn in the size cycle. And lo and behold, I think it has legs.
Yeah, no, I do too. I mean, two data points I hung on to is the percentage of unprofitable Russell 2000 companies dropped from about 40 to 23%. And then the earnings growth rate was really accelerating like 2 or 3 times faster than for the large caps. Yeah. So, which brings me to the next thing, which I love. I talk about like, where do you look for investments? And your knee jerk already was like stocks, because earnings are growing so fast. I always say earnings are the mother's milk of profits, because they just drive stock prices no matter what. If they keep going up, stock prices are going to follow. But tell me your viewpoint on it too. And how do you see this acceleration in earnings? Is it sustainable? Is this 6th quarter in a row of double-digit growth the peak? Where do you see this leveling out? So
it never ceases to amaze me, Lou, how investors are caught off guard by the power of the rebound in corporate profits off the major lows. And it wasn't that long ago we had a recession in corporate profits, 2022. And so the math, that's just how it works. And I think we have a ways to go here. And it's driven by margins.
Yes. No, that is, 13.4, 13.5%. I believe that's the highest in 15 years.
Yes, right. Yeah.
So how do you this is my read through. You tell me, you're the more of a market strategist than me on this, an economist, but my read through there is, even if we get a little bit of inflationary pressure, increasing costs, companies have the buffer to start raising wages more aggressively to help compensate for that, versus being in a very compressed margin environment. Is that wrong, correct, inaccurate, incomplete?
Well, no. So again, I didn't share this one with you, but
you're holding out on me?
I am, but hey, it's okay. We're here. Some inflation can be very good for stocks through the revenue, margin, and earnings channel. So this is macro strategy 101, but just take a look at the spread between PPI inflation and CPI inflation, which is a proxy for the prices that producers receive and the prices that consumers pay. What's it doing? Trending higher. Lo and behold, we have the magic ingredients for margin expansion. Yeah, no, I'd love to see it. So we look at margin expansion happening. We see earnings growth happening across the board. It's not just Mag 7. If we strip out NVIDIA, actually the unmagnificent 493 are growing faster than the Mag 6 group. Yeah. Where do you see the pockets of growth being the strongest? I mean, are you leaning in tech? Are you leaning in discretionary, energy? What stands out for you? So if memory serves, like, you're asking about what could drive the next leg for a broader market, I think it could be good old fashioned earnings, because all sectors are now growing. And I think 7 of the 11 are actually double-digit growth. So this is, to your point, not just the 6 best companies that are fueling the rally here. So you said last year in April, you put money to work in small caps. Where's an area now that might be a little bit out of favor, unloved, maybe undervalued, that you think makes sense to put new money to work? So maybe a bit of a contrarian play when thinking about the size strata. The ones that have not participated enough or as much, but might be on the verge of breaking out would be the smaller large caps, like the equal weighted S&P.
Yes.
Right?
Yeah,
Flirting with prior highs, right?
Yeah.
As well as the mid caps. So keep your eye there. But we need to end the war, Lou.
So what and that's a great point. And I agree. Like I think the equal weight S&P is only up 6% year to date. So, S&P now is much higher after this rally, but how long is too long for the war? Where do you start getting concerned? I said for me, it's a midterm math to get the average price of gasoline down far enough. This war has to be over by Memorial Day, maybe the end of March, but how do you see it?
So I think we've got a couple of things. It's going to become more and more costly, which creates a sense of urgency for the administration, not just from a cost perspective, but from a political perspective, because the midterms are coming up. I don't know how much Trump really cares about those, but the party certainly does care. So we're kind of getting more and more reasons to wind it down sooner rather than later. Where are we now? 2 months in?
Yeah, I think it was supposed to be 3 to 4 weeks, but so was the Ukraine-Russia war, right? It was supposed to be 3 weeks, and here we are 3 years later. So yeah. So long in the tooth for you is as the costs continue to go up, and how do you fund it and not push the pressure through? All right. Well, we covered a ton of bases here, but if you haven't noticed, we're all about all filling, zero fluff, and so is our email newsletter where we deliver insights, one headline that you should probably ignore, one chart you should absolutely pay attention to, and one investment idea that you should follow to increase your bottom line right alongside ours. So if you're not signed up yet, go to thebigskinny.com, sign up for our newsletter. If you can't be bothered to give up your email address, that's okay. Give us a follow on Twitter or on YouTube so you never miss another episode. Before we run, I want to cover a couple other things. Some fun, lighthearted, others a bit more serious. AI jobs dislocation. Are you seeing it or are you not believing it's happening?
So that's a great question. And this morning I was just looking at the unemployment rate for 16 to 24-year-olds. And you would expect that cohort to be the most disrupted by AI. But that unemployment rate is fully a point lower than where it was last summer.
So it's coming down as AI use and productivity
has gone up. So how does that work? So I'm going to throw a very simple economic framework at you. Supply, demand, price. So could it be, and this is the what if classic comic book that we all remember from Marvel back in the day. What if the lower cost of labor that AI could bring about could actually boost the demand for potentially cheaper labor down the road? So we could actually see us getting out. That might be a pathway out of this kind of payroll malaise we're currently in.
No, that's interesting. What do you make of the latest, call it last couple months of employment reports? I mean, most recent one, we saw another month of growth. The previous month was revised higher, but then in January we had that out of nowhere 92,000, decline. Yeah.
So, I mean, Great point. When in doubt, zoom out, right? So I like to look at the underlying growth rate of non-farm payrolls. And unfortunately, the reality is that it's flirting with basically a goose egg, Lou. So I think what that does is remind the Fed, do no harm. And I'm pretty sure they're going to exhaust all avenues before they ultimately do the right thing. So we might be waiting a little bit longer, but there is a fundamental reason for them to resume their interest rate cuts and kind of lend
I was just going to ask next, what do you think Walsh does? Does he cut for just to appease the administration and then move to a hold? I mean, some people I've talked to recently think he's a hawk in dove's clothing right now, that he's going to come on much more historically. He's been a bit more hawkish, but you think we get a cut next?
So I think that there's a fundamental case for that. And we might get there through no increase in the balance sheet and lower rate path or resumption ultimately of those rate cuts. I take that, and I think it'd be well received by markets and investors. Yeah, no, I agree. I think we get one and done, and then he starts unwinding the balance sheet, which just neutralizes it effectively, and then we see what happens. But all right, fun question. Best martini in New York, best place to get a martini, in your opinion? Oh my, I'm a fan of the last word, l'ultima parola, and I make them at home. That's probably the best place to do them. But
you heard it. We're all going to Talley's house for a good martini.
You are welcome.
What do you think of private credit? Contained or still contagious at this point?
Well, so the way I'm thinking about that is software has been quietly basing. And I think that was the real pressure point for a lot of those companies and the publicly listed private asset managers. But I see similar easing in the pressures on financials more broadly as we rally to new highs in stocks. And so if that's the right way to think about it, I'm not a private to asset expert.
Yeah.
I do think that we could be back to the races there.
But I think that's interesting to say, like the pressure was being extracted most on or exacted on the software space the most. And now you're seeing that bottoming. Do you think that there's a real threat for AI to get rid of some of these big names in software, or do you see them just kind of re-rating, figuring out what the new valuation model is?
Well, so that's a great way to put it, Lou. We've had a pretty nasty re-rating in the valuations of those software companies. But again, it gets me back to pricing and demand. So what if AI is able to allow these legacy SaaS companies to figure out new and better ways to cut costs and create better software solutions, thereby boosting the demand for those things?
Yeah, so it's classic creative disruption. It's just a little painful in the middle.
Schumpeterian growth, baby.
Yeah, absolutely. Where do you think we are in the AI cycle if we talk about Schumpeterian, like crossing that chasm? Or have we done it yet? 20% market penetration, or are we still super early innings?
Well, another way to look at this, and I've got a cycle on cycle chart that I like to flash that compares the rally in technology stocks since the launch of ChatGPT, overlaid with the launch of Netscape Navigator.
Oh my God.
Remember that one?
Jeeves just closed down, and now we're going back to Netscape.
Yeah. Well, so that prior experience was almost 1,000% rally.
Yeah.
And so I think with the current one is closer to 200 or 300%. And so if past is prologue, I think we got a couple years to go here. Yeah.
I love it. I love hearing that. Anything that you think investors should be paying attention to that no one's been asking you about lately? Like what's on your radar that seems so obvious that no one seems to get yet?
So the dismal science, I got a lot of angry economists that I talk to who are deep, good friends, and they're sticking to their negative bearish recession narrative. And I get it. But listen, folks, please watch the high frequency data. The weekly economic index here is actually reaccelerating to 3%.
Yeah.
I think there's a tracking model that's saying something very similar as a 3 handle. Plus, we have the surprise indices hooking up now. And so, I don't think things are that bad. You add 27% earnings growth, stick to the signal, ignore the noise.
So you still see a bunch of surprises to the upside. I mean, that's starting to happen.
That's happening, yeah.
Yeah. Why do you think analysts are always so wrong? Like, is it a function? I mean, is it like the weathermen? They just have the best tools and still can't get it right? Or is it really more just a group think and it's safer to stay within kind of the confines?
Well, I think there's plenty of research, academic white papers on that subject. And I think it does have to do with behavior and crowding. Yes. And there's a calendar effect too. People push out their estimates till the second, third, and fourth quarters, and they don't really deal them until it's staring them straight in the face. But I think we're on the positive side now, where we're seeing the upward revisions. And
yeah, well, listen, I'm a glass half full guy. So you're welcome anytime because I don't need
Martini glass.
Right? Negroni most of the time.
Negroni.
So, but hey, Wealth Consulting Group, tell us more about what you do there. How can people find I know you have a letter that goes out. You do a weekly podcast. Where can they find more information and insights from you? So
Jimmy Lee's firm, we're an $11 billion registered investment advisor based in Las Vegas, Nevada. I live in Jersey, but you can reach me on social, and we would be happy to open some accounts and get you to work in these markets.
Awesome. Well, I really enjoyed the conversation. Look forward to the next one with you.
Thanks,
over a martini.
Yes.
At your house. Oh, man. I'd love to have you back again.
100%.